A reinstatement clause in a reinsurance treaty allows an insurer to restore the reinsurance coverage limit after it has been exhausted or reduced by a claim. This provision is commonly found in excess of loss and catastrophe treaties, enabling the insurer to replenish coverage for future losses during the same treaty period, usually in exchange for an additional premium. Key features: restores coverage. After a significant claim depletes the reinsurance limit, the clause allows the insurer to reinstate coverage for future claims within the same policy period. Types of reinstatement. Automatic reinstatement. The reinsurance limit is automatically restored after a claim. Optional reinstatement. The insurer can choose to reinstate coverage depending on future risk and costs. Reinstatement premium. Restoring coverage usually requires an extra premium, calculated as a percentage of the original premium, often based on how much of the limit is reinstated. The premium can be prorated based on time or the amount of coverage reinstated. Number of reinstatements. Single reinstatement allows the limit to be restored once. Multiple or unlimited reinstatements provides flexibility by allowing the coverage to be reinstated more than once after major claims. Full versus partial reinstatement. Full reinstatement restores the entire original limit. Partial reinstatement, only a portion of the original limit is restored. Example: an insurer has a $10 million XL treaty with one automatic reinstatement and a 50% reinstatement premium. After a $9 million loss, the reinsurer pays the claim, leaving only $1 million in coverage. The insurer can restore the full $10 million limit by paying a 50% premium of the original, ensuring protection for future claims. Importance of reinstatement clauses. Continuous protection. Reinstatement clauses ensure coverage remains available even after a large claim, crucial for insurers exposed to multiple risks. Risk management. Without reinstatement, the insurer could be left unprotected after a large claim depletes the limit, increasing exposure. Reinstatement mitigates this by restoring coverage. Flexibility. The option to reinstate coverage multiple times offers protection against frequent or severe losses over the policy period. Cost management. The prorated reinstatement premium helps insurers manage costs by paying only for the reinstated portion of coverage. Drawbacks and challenges. Cost. Reinstating coverage often comes with a significant premium, which can increase the insurer's costs, especially if multiple reinstatements are required. Limited reinstatements. Some treaties limit the number of reinstatements, potentially leaving the insurer exposed if there are multiple large claims. Timely reinstatement. Insurers need to act quickly to reinstate coverage after a major loss to maintain protection against future claims. Use cases for reinstatement clauses. Catastrophic risks. Insurers in high-risk areas use reinstatement clauses to ensure continuous protection throughout the season. High-risk sectors. Insurers covering sectors such as energy, marine, and aviation benefit from reinstatement clauses to manage the risk of multiple large losses during the policy period. Aggregate losses. Insurers facing numerous smaller claims over time may use reinstatement clauses to restore coverage, ensuring they remain protected over the entire treaty period. Conclusion. A reinstatement clause in a reinsurance treaty allows insurers to restore their reinsurance limit after it has been exhausted, ensuring continuous protection for future claims. In exchange for a reinstatement premium, the insurer can replenish the coverage, reducing exposure to multiple losses within a policy period. These clauses are crucial for insurers facing high severity or frequent claims but come with their own drawbacks and challenges.